Hi, my name is Muhammad Syakal Aiman bin Fauzi. My ID number is MDA22079095. Today, I would like to present to you two public companies that we create. The first one is a construction Inc. and the second one is a global logistic solution. For the construction Inc. operate in the construction industry, focusing on the large-scale infrastructure projects such as highway, bridge, commercial building, and residential development. The company operation also heavily rely on the various type of the heavy machinery and equipment, which is categorized under property, plant and equipment (PPE) according to MFRS 116. Now we go to the second company is the Global Logistics Solution. The Global Logistics Solution is a prominent player on the transportation and the logistics industry, providing comprehensive supply chain and solution to business cross over the various sectors. The company offers a flight of the forwarding, warehousing, distribution and the custom brokerage service to streamline global trade operation. Global Logistics Solution leverage advanced logistic technologies and strategic partnership to optimize the supply chain efficiency, reduce costs, and enhance delivery speed and reliability for each client worldwide. They have three plant and property and equipment (PPE) according to the criteria recognition in the first company. The example of the PPE is include crane, which are essential for lifting and moving heavy material on the construction site, excavator used for the digging foundation and the trench, and also truck necessary for the transportation materials to and from the construction site. The recognition criteria for this asset differ. Cranes are recognized at the historic cost, which include the purchase price and installation cost. Excavator are recognized using the reversion model, reflecting the market value at the recognition date, and the truck are recognized at the fair value consideration the current market price at the time of excavation. Okay, for initial measurement, they have three assets that we use. First, crane, excavator, and truck. For the crane, we use historical cost method. For excavator, we use revaluation model, and the truck we use a fair value method. Now we go to the first initial measurement, which is crane that we use the historical method. The assumption is the purchase price of the crane is 500,000 ringgit and the installation cost is 50,000 ringgit. The transportation cost is 10,000 ringgit. The calculation is initial measurement equal to purchase price plus installation cost plus transportation cost. That means 500,000 ringgit plus 50,000 ringgit and also plus 10,000 ringgit equal is 560 ringgit. 60,000 ringgit. Explanation is the historic cost method consider the purchase price along with any cost directly attributed to the bringing the asset to the location and the condition necessary for it to capable of the operating in the manner intended by management. In this case, the initial measurement of the crane is 560 ringgit. That's all from me.
Hello, my name is Amirul Hafi bin Mamalim, and I will be explaining the next PPE, which is excavators. So for excavators, we will be using the revaluation model. So this is our assumption: the market value is 300,000 ringgit, and the revaluation surplus is 20,000 ringgit, and our accumulated depreciation is 10,000 ringgit. So for our calculation for the revalued amount, we take the market value, we add on the revaluation surplus, and we minus the accumulated depreciation, and that leaves us with 310,000 ringgit. So this is our explanation for this. The revaluation model requires that PPE is carried at a revalued amount, which is the fair value of the date of the revaluation has any subsequent accumulated depreciation. Here, the excavator's initial measurement after revaluation is 310,000 ringgit. So the next PPE is trucks. For trucks, we will be using fair value method, and our assumption is the current market price of the truck is 100,000 ringgit. The cost of necessary modification is 5,000 ringgit, and the transaction cost is 2,000 ringgit. So the calculation for the fair value measurement is market price plus cost of modifications minus transaction cost, and that will leave us with 107,000 ringgit. So this is our explanation. The fair value method involves measuring the asset at its current market value plus any cost required to modify the asset for its intended use and any transaction cost incurred to acquire the asset. In this case, the initial measurement of the truck is 107,000 ringgit. Now, as you can see, this is our journal entry on above transaction. We will start from year 2 until year 10. So by the end of year 10, the market value is 400,000. And this is our accounting treatment. Now, for the revaluation surplus, when the fair value of an asset increases, this increases is recognized in equity under the revaluation surplus and is not immediately recognized in profit or loss. For example, in year 2 for construction Inc., Crohn's, the revaluation surplus of 40,000 is credited to the revaluation surplus account, revaluation deficit. When the fair value of an asset decreases, the decrease is first offset against any existing revaluation surplus in equity. Any remaining deficit is recognized in profit or loss. For instance, in year 4 for construction Inc., cranes, the revaluation deficit of 50,000 ringgit is debited from the revaluation surplus account. If the revaluation surplus is insufficient, the remaining amount will be recognized as an expense in profit or loss. Next, we'll be looking at accounting treatment for financial statement impact. So at the balance sheet, as we can see, the carrying amount of PPE on the balance sheet is adjusted to reflect its fair value after each revaluation. The revaluation surplus resulting from this adjustment is included in equity income statement. The depreciation expenses is recognized in profit or loss, reducing net income. Additionally, any revaluation deficit that exceeds the revaluation surplus is recognized as an expense in profit or loss. Equity. Revaluation surplus is included in other comprehensive income forms part of equity. That is all from me. Thank you.
Hello and Assalamualaikum. My name is Muhammad Fadilan Shakiri bin Muhammad Shukri and my ID number is MBA2207046. Okay, assume company have minimum of two investment property IP including the criteria recognition. First, we have a high risk office building. This building is leased out to various corporate tenants to generate substantial rental income from long-term lease with tenants. Second one, retail shopping complex. The complex is rent out to the various retail business and shops. The company receives regular rental income from tenants. The third one, we have land held for capital appreciation. The land is held primarily for capital appreciation, not for production, supply of goods or service, or administrative purpose. Fourth, we have land held for uncertain future use. This comprise land that is not planned for immediate use in the production of or for sale in the normal course of business. Second, we need to estimate initial measurement for PPE by different methods. Higher mark given by based on gravity. Okay, first we have land with cash method and building with self-constructed method. First, we have land with cash method. The assumption is the purchase price of the land is 1 million ringgit, and the stamp duty cost and the insurance on building is 5 5,000 ringgit and 20,000 ringgit, and the administrative cost is 21,000 ringgit. So the calculation begins with the purchase price plus with the stamp duty and insurance on building. So the initial measurement is RM1,025,000. So for the building, we use self-construction method, which is include the constructor cost, direct materials, direct labor, general administrative overhead, site preparation cost, engineering overhead, professional fees, permit and license, interest, plus interest on construction loss. We have to minus it with the inefficiency. So the total initial measurement for the building is 19,005,550 ringgit.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nabil Mirza bin Salihuddin. So today I would like to present about our investment property on the transaction in the journal entry. So on the 1st January 2012, we are buying a property for the investment at cost 1,051,000 ringgit. This is including a stamp duty, legal fee as much as 10,000 ringgit, which is 5,000 directly, and 21,000 for the insurance on the building, and also 21,000 in the administrative cost. So we also record the administrative cost as not expense of, which is we got 21,000 on the 1st January 2012. So next we move to the 2014, we are again as much as 75,000 again. So at 2016 we are having losses as much as 100,000 again. So on the 2018 we gain as much as 200,000 ringgit at the year. So next we move to the date 1 January 2020, we gain on the investment property as much as 50,000 ringgit, and also we are having loss, we are having profit and the fair value of the investment property at the end 1st January 2020 as much as 1,150,000 ringgit. So next we move to the accounting treatment. So the initial recognition, the investment property was initially recognized at cost, which includes the purchase price, legal fees, stamp duty, and also the administrative costs directly attributed to acquiring the property. Administrative costs not directly attributed are expensed off immediately. So the next we move to the subsequent measurement. Fair value model. Hedging solution industry choose to measure the investment property using the fair value model. This requires revaluation of the property at the end of each reporting period, with fair value changes recognized in the profit and loss account. Gains increase the carrying amount, and also if the losses, it will decrease it. So now we move to the journal entries. For the journal entry, each of fair value adjustment is recorded to reflect the changes in the fair value and its impact in the financial statements. Gain and losses are recognized immediately in the profit and loss account. To ensure the transparency and accuracy in the reporting is the property for the fluctuation. Next, we move to the financial reporting impact. Using the fair value model provides stakeholders with updated and relevant information on the investment property value, reflecting market condition and property performance over time. It enhances transparency and helps in making informed decisions regarding the investment property management and potential future transactions.